Okay, 11 o'clock. Let's get going. So this week's guest is Richard Aston from CC Japan Income and Growth. So we'll be talking to him in a little bit. First, a bit of news to have a look at. So three things that I pulled out from this week. Hipgnosis is an obvious one. I thought we'd have a look at Alliance Trust results versus F&C results because both came out this week. And then just a quick mention of the triple point energy transition idea. Hipgnosis first. Now, obviously, the big news this week, but they've revalued the portfolio. So Morningstar hasn't quite caught up with this yet, but the effect is that the NAV dives, and obviously that means that the discount is not as wide as it looks. So I reckon the discount now is about 34%, something like that. It's still a decent size, which is why we spent so much time on it. But nevertheless, it is not as cheap as it was. Shot Tower Capital, who the board asked to have a look at the valuation, have come up with a number that is an awful lot lower than the Citron Cooperman one. They're basically saying a range of about 1.8 to 2.06 billion. There's still provision for bonuses on the catalogues that have been bought, but lower than the Citron Cooperman one by a little bit. And that comes up with NAV of about $1.17 per share, which is about 92p, which is obviously an awful lot lower than the 137p that we had under the end September valuation from Citron Cooperman. Now, it's not clear to me whether this is an official NAV or not, or whether they're just publishing this for information purposes. And that might be why Morningstar's not reflected it in its numbers. But anyway, I think it makes sense to use this going forward. Now, there's an issue around this because obviously, if you drop the asset value, that just pushes up the gearing. So it's important to have a look at that. It does feel to me, and this is slightly confusing, but it does feel to me that the amount of debt's dropped by quite a lot. So it was 624 million at the end of September. That's in the accounts. We know that they did sell a little bit of the catalogue in December, so about $23 million worth. So that knocks off that. We know also that they stopped paying dividends, so that cash stopped outflowing, and they're still getting cash in from the portfolio, so that's all good. But nevertheless, based on the numbers that they provided, it seems to imply that the net debt's now 515 million. I can't swear that that's right. It just seems very low to me, and I can't work out why it would have dropped so fast. But there we go. Nevertheless, that is still too high. So on the lower asset value, that gives you a loan to value ratio of 26.7% or gearing, which is debt over net assets, of 36%. And they're not supposed to breach 30%. That's down to the investment policy, not something from the banks. So the board has said, right, no more dividends for the foreseeable future. And that's obviously what's driven down the share price, I think, rather than they've dropped it enough, which people probably saw coming anyway. Why has this happened? It really just comes down to the fact that Citron Cooperman doesn't seem to have made any adjustment for the fact that the risk-free rate, which is generally the risk on US government bonds in this kind of instance, has gone up quite a lot. So most of the money was invested from launch here through to here, really. And so I'm talking to people about this last night, and there's a lot of question about whether they were overpaying for catalogues. And I think there's a debate around that because it depends. It's because it's all against this context of low and falling risk-free rates. And so had this not changed, I think you could maybe have justified the previous valuation. But the fact that it did this, and there was no reflection in that in the discount rates, there's also value on discounted cash flow. That was clearly wrong. And so I'm not in the camp that says that they were overpaying for catalogues, but I definitely am in the camp of saying that they should have been reflecting a lower valuation. So there we go. Now we just have to wait and see what the next step in this is going to be. But hopefully this will flush out a bidder, because obviously, if they're saying we think it might be valued somewhere down here now rather than up here, that does mean that the bidder's got an awful lot more wiggle room in terms of what they're going to offer. And shareholders have approved this idea that the board will subsidise you if you make a bid and then the manager comes in and exercises his option to buy the portfolio at the same price. So that should help too. There is this litigation, annoying, stupid litigation going on that really shouldn't be there. But again, the manager's got to step up and do something about this. I think that means that nobody want to buy the whole company, but you can still get rid of the whole portfolio and then find some way of retaining the cash beyond that. So fingers crossed, we'll get some more positive news on this going forward. But there we go. Just briefly on Alliance Trust versus F&C. They both announced results this week. They're very different, and you can see that it's 10 percentage points more Alliance Trust return rather than F&C. It's also been doing an awful lot better job at controlling its discount. So this morning, the discounts are about 5% different. And although it didn't raise its dividend by as much as F&C's, it's already on a high yield. It was a difficult year last year to beat the index. So the All Countries World Index returned 15.3%. So the F&C's will be quite a long way behind that, but Alliance Trust is quite a long way ahead. And you can see it was a difficult year because the universe of open-ended and closed-ended funds, which is this Morningstar universe here, only returned 12.7, so that most funds underperformed. And that's all because of this Magnificent Seven thing. So both trusts had some exposure to the Magnificent Seven. Both trusts were underweight, though. Both trusts had exposure to both value and growth stocks. But I think the real winner here is the fact that Alliance Trust has got this style neutral idea. So they're not skewed one way or the other, whereas F&C seem to end up with too much in value at the beginning of the year. It's also got some private equity exposure, which wasn't helpful. So this is Alliance Trust, and you can see here that all of the excess returns are coming from stock selection, which is exactly what it's supposed to be doing. So that they are paying these group of managers to come up with their best ideas and put those into a portfolio that's then sort of balanced from a risk point of view. And that just seems to be working. As I say, yeah, they do have some contribution from these Magnificent Seven, so Alphabet and Amazon in there, but also things you've never really, I've not stock I'd even heard of, Kindle. And it didn't matter that they didn't hold all of them. So that there's 3 of the Magnificent Seven that they're underweight there. So to me, this is just confirmation of that this Alliance Trust approach is working. They added a new manager, Dalton. We've talked about that one before, I think. It's value focused. Jupiter is still up for review. They didn't make any comment about what they're going to do with this because obviously the manager's leaving to set up on his own. But they won't have any trouble finding somebody to slot them in if they need to replace them. So yeah, I still like this going forward. F&C, although the private equity was a real negative there, you can see negative return, and it's 10% of the fund, or 11% of the fund. And the other problem they've got is they were underweight the US, and they underperformed, and that I think is really what drove the numbers down. Some years this worked, some years it won't. I just think that the Alliance Trust is a more sort of stable bet going forward. And interestingly, even though we go back 10 years, Alliance Trust was in a real mess before Willis Towers came in, and its numbers didn't look very good at all. It's now pulling ahead of F&C over 10 years. And yeah, long may that continue. We'll have to just wait and see how that works out. But it's the one I favour. I've written something about this today in sort of more long form. Where's the discounts? It's also been buying back an awful lot of stock, so it's doing a good job of controlling its discount. And to be honest, I think these returns justify a narrow discount anyway. F&C's though seems to have sort of drifted away from itself, and I don't know how that's happened. But That's way too wide, 10.5% for a fund like this. One last thing from me before I pack up. Triple point energy transition. So we knew this one was going to wind up. We were waiting for details of how it was going to proceed with this. They've published a circular this week that shareholders will have to vote on. And one of these ideas that's in there is that the manager gets a success fee for selling off the assets. But this is not a success fee because they basically get rewarded depending on how little they lose relative to the current NAV. That seems so unambitious to me that I'd recommend voting against it. And I hope shareholders kick off and oppose this. I can't see how they can justify it. There we go. Good. That's enough from me.